Thanks for being on.
Hey, good morning. I love Live Friday, and what a good week. And I think it was all attuned to one simple thing: the lack of any actual hard evidence on tariffs beginning day one of this new administration. I think that's really what caused the relief rally in stocks because the tariff fears were too aggressively priced into markets, and that's what gave us all a dose of reality and Tylenol. We'll see what happens when all the federal agencies come back with their reports on April 1st.
Right, and then it's interesting. I just did a radio show in Detroit, believe it or not, and that was really all they wanted to talk about was tariffs. And I'm not so sure. It seems as though he has backed off a little bit. Do you get that sense too?
Well, very much so. And I remind everybody, you and I talked this all in the fall. You can't do all of this with executive order. We actually have trade pacts and trade agreements. Many of them are actually not unilateral, they're bilateral, and it is going to take some acts of Congress to get things done. Now, what Trump did do, not to disappoint anybody, is he instructed all of the various federal agencies to study the trade relationships. He did do that on day one to determine if anybody's acting in less than good faith. But those findings aren't due until April. So I don't expect to see any action on trade, tariffs, etc., really until we get to the spring. But we all have to remember, a poorly executed high tariff environment that would boost inflation, hurt growth. And this time around, we got an S&P price for perfection, very different than where we were in 2017.
We're getting a lot of those beginning of the year expectations for the S&P. Yardeni came out. Ed Yardeni, I think you know who he is. He's talking 7,000 by the end of this year, 8,000 by the end of next year, and 10,000 by the end of the decade, 2030. That's what, I don't know, depending on where you're at and how you do your math, around 10, 12% return each year, which is pretty close to the high end of normal. Are you on board with that?
I think it's going to here. I think a multi-asset class portfolio can definitively deliver because there are value in certain capitalizations. There is value certainly around the globe. But if we're talking just the S&P 500 composite, you got to be honest with yourself and say we're trading at 270 times earnings, a 21 multiple right now. And any deterioration, just bringing the multiple back in line, has some significant consequences. But I do think equity investors and those who are willing to commit to that risk premium, which most people should if they want to get retired and stay retired, can achieve double digits in the decade to come on the equity portion of their portfolio. I think Ed Yardeni is probably spot on there because if history is our guide and it's the only guide we have, why wouldn't that continue?
It's hard to, if we do see a 10-year yield at 5%, it's hard not to put some money into that, wouldn't it be?
Well, I think everybody has to have a dose of responsibility. Remember, our first goal is to be a good financial steward of our money. And that means any dollars we're investing in publicly traded equities really do need to have a time horizon of 3 years at a minimum, 5 years more likely. And that's the reason that parking money in treasuries and other forms of credit today, when you're going to get a yield higher than inflation. Scott, I know it sounds weird to say 5% high is higher than inflation, but 5% going forward from this day is better than inflation, and that does make it a viable asset, not just for those who are looking to take income, but those who are modeling a portfolio.
And I think the expectation for that the 10-year yield at 5%, is because we might have some inflation, or at least it might be stickier than most people think. I'm kind of in that camp. Where do you like?
I'm in the camp right now that at best we are going to get 2 rate cuts in 2025.
Wow,
Yep, I'm still saying it. It makes some people's heads spin. Again, I want to go on record saying I don't see any of those cuts happening until July or September at the first potential opportunity because there's so much that needs to be navigated right now between monetary policy, Treasury policy, and what we're going to see in fiscal discipline. Notice I said fiscal discipline, not fiscal spending, right, Scott? And the Fed's going to wait for that data to come through. If that is the case, then yes, Ed Yardeni is going to be right. Some of these estimates are going to be right, and we are going to have yet a third year in a row of potential double-digit growth in equities. But I do think, again, people need to take a look and accept that the jobless claims, just like they went up a little bit higher than we thought this week, that's going to continue. The inflation, the last yard, the last foot, and the last inch is going to be really difficult, and it is going to be stickier than people want for at least the foreseeable future.
Hard to argue with that, brother. I appreciate you coming on and getting our Friday started for us. It's Call In Friday, see if we can get some people off their keisters and let us know what they're thinking. Craig, really appreciate everything you do. Thanks for being on the show. Craig Bolanos, co-founder and wealth manager at VestGen up in Chicago. We're going to go away. We're going to pay some bills. We're going to come back and talk more right after this.
It's Farmer Friday. I am Darren Hefty on the next Ag PhD radio show.